Hi everybody, I hope you can see me. I want to go through this cash flow statement we've got in chapter 2 to show you how we come up with the cash flow from the balance sheets. And you can see that I've got the microdrive balance sheets that's shown in the text with the assets and the liabilities and equity, as well as the income statement. So what I've got over here is a cash flow statement that I'm developing, and as you know, cash flow statements includes three things: cash flow from operating activities, cash flow from investing, cash flow from financing activities. And so we've got here the income before preferred dividends is, you can see down here, I'll click this like this, and you can see where I get that from. So I pull that number from the income statement, and then to that I'm going to add the depreciation. And you know we add depreciation because depreciation is a non-cash expense. So we got to add that back in to get in the cash flow. Now we increased receivables, and you can see it. We went from 315 to 375, and that's an increase of 60. And so that increase reduces cash flow. The same is true with the inventories. Inventories go from 415 to 615. That's 200. So there was 200 impact on cash flow for that. Now accounts payable went up from 30 to 60. It went up by 30. So that increased cash. Increase in accruals. The accruals, there was an increase in the accruals. It goes from 130 to 140. So that adds to the cash. So the net of all those numbers is a minus $2.50 or $2,500. I'm sure that's the way we've got to say it. Now, increase investing activities. We increased the activities there. We went from 870 to 1,000. That's after depreciation. So that's 130. But to get there, we have to add back the 100,000 in depreciation because that reduces the net plant and equipment. So that 230 is the composition of the increase in the after the net plant and equipment plus that depreciation. Now, from that we had a sale of short-term, sale of short-term investments. We sold them, reduced it, that increased the cash flow. So the net cash used with investing activities, you can see, is 165,000 here. Now we've got financing activities, and one of the things we have is we have to increase notes payable. It goes from 60 to 110. That increased cash flow. Increase in bonds goes from, I gotta hit that right, I'm sorry. I'll do that right this time. Okay, it goes from 580 to 754. That's $174,000 increase in cash flow. So basically, they've increased their assets, their fixed assets, and they paid for that by a lot of it by this increase in this cash bonds. Now we paid some dividends, and we paid two dividends. We paid the preferred dividends of $4,000. and the payment of the common dividends of $57.5 thousand. So that's a total of $61.5 thousand of payment of dividends. So the net cash provided by that is $162,500. Now, if you sum all that up, the net you add is they take the let me do that. If you take the $2.5 thousand that was reduced because of operating activities, and to that we subtract add 165,000, and to those and then we add the 162,500, and we come up with a net change in cash of $5,000. And the cash at the beginning of the year was $15,000, and that you can see that one comes from over here. You pull that over there. And then we add subtract the 5,000, so then we come up with 10, and that's equal to the cash at the end of the next year. I just thought I'm going to save this so you can in integrity, so you can go into it in your after evening's hours of study and see how we come up with these numbers. Thank you.